David Goldberg, Hilary Bricken, and Larry Gill. David Goldberg has specialized in credit investing for the past 25 years, managing proprietary investment portfolios at leading Wall Street firms and hedge funds. Before joining Merida in 2017, he founded Battleburn Capital, a cross-capital structure investment firm. Prior to Battleburn, Mr. Goldberg served as the senior member of the New York office of Silver Rock Financial, Michael Milken's family office, from its inception in 2010 until his departure in January of 2016. Hilary Bricken is a partner at Harris Bricken in its Los Angeles office, licensed to practice law in California, Washington, and Florida. She is one of the premier cannabis business and regulatory attorneys in the United States. As chair of Harris Bricken's Regulated Substances Practice Group, which includes the Canna Law Group, she helps cannabis companies of all sizes with their cannabis-related legal issues. And Larry Gill is a partner at Nelson Hardiman and oversees the firm's financing efforts, focusing on debt, including term revolving convertible debtor in possession, bankruptcy exit financing, factoring, secured and unsecured, and equity, primary equity, warrants, shadow equity, profit participation, as well as other private investment and securities transactions. Larry also focuses on mergers and acquisitions, both equity sales and asset sales, in the healthcare and life sciences business sectors, with a recent emphasis on financing and M&A within the adult use cannabis space. Please welcome David, Hilary, and Larry.
Thank you very much. Can you hear me? Does this work? Okay, great. Thank you very much. It's my honor to be here today. My name is Larry Gill. I'm really extremely honored to be with the lady and the gentleman on my left who have a lot of experience in the industry. Just very briefly, was there something to move the slides along? I don't know.
Yep.
Aha. There it is. Okay, got it. My presence and very active involvement in the cannabis industry really comes from a hybrid career that I've had. I began as a lawyer a lot longer ago than I'm sure Hilary did. In the 90s, I was with Milbank Tweed, and I was doing bankruptcy law, representing bondholders in the early stages of the sort of trade, claim trading, having control of the industry. I left the practice of law after about 6 years, and I started my own hedge fund and ran it for about 16, 17 years. My entree back into the legal world actually came after I was approached by Harry Nelson, the founding partner of Nelson Hardiman, who is a guru in the healthcare regulatory life sciences space. And if you don't know Harry, you should. He's fantastic. Harry had a great idea to start a private equity, I suggested, hybrid fund for the life sciences healthcare sector. And in that process of attempting to raise money unsuccessfully, I might add, we became very close, and he brought me in to run our finance group. The reason that I bring all that is not to pat myself on the back, because I'm sure you're all bored to death anyway, but my perspective really is dual. I am an attorney, and I focus on financing and all the issues that arise there, but my mentality and the mentality of virtually every one of my clients is that of an investor. An equity investor, a debt investor, and so I feel like this is a very good panel for me to be on. Again, I'm very honored to be with the people who are sitting to my left. I don't think there's anything. Yeah, there's no. It's in the books. There's nothing particularly interesting in my slides, but I do recommend that that you do look up the firm, and especially Harry Nelson, who's fantastic, and has been involved in legal representation in the compassionate care area of cannabis since its inception. And I'm going to pass it over to David Goldberg.
Thank you. Can you hear me? Work? Okay. I'm David Goldberg, a senior partner at Merida Capital, which is a private equity vehicle investing exclusively in the cannabis and hemp CBD space. Let me just hold on. Right, that one's back. To date, we've raised nearly $100 million of capital and just launched our third fund. And we have over 30 portfolio companies, which are outlined or laid out here in this slide, and are involved in every facet of the industry, including grow supplies, packaging, lab testing, compliance, data, cultivation, dispensaries, distribution, marketing, and brands. On this panel, you're going to hear about how challenging investing in the cannabis sector is from a legal, governance, due diligence, and valuation perspective, and that is absolutely the case. The cannabis opportunity is much more complex than most investors appreciate, with constantly changing legal, regulatory, and business dynamics. Long-term investment success will depend on engaging the right manager who has experience navigating this terrain. Merida brings years of institutional experience and knowledge to the sector that is difficult to replicate. At Merida, we are constantly speaking with our portfolio companies to understand the state of play. We hear dozens of pitches every month, so we have a pretty good sense of industry trends and which management teams are on the right track. Now I'd like to turn to discuss industry trends. The first is regulatory complexity and compliance. Federal oversight is beginning to increase as the regulatory framework evolves. This means that agencies like the EPA, IRS, Department of Agriculture, and the FDA are going to be much more intrusive and set higher standards for the industry. This will be a major gating issue for many companies, and many will not have the resources or management depth to compete or scale in a highly regulated environment. The next is cannabis-based medicines. The industry is evolving from a recreational and medical model to one where cutting-edge companies are focused on cannabis-based solutions tailored to ameliorate specific conditions. Research, data, and ultimately clinical studies are key to developing cannabis-based medicines, which we believe will be one of the next major opportunities. And this is an area that we are very focused on. According to a New Frontier consumer survey, consumers increasingly want a particular physiological response when taking THC and/or CBD. Among medical cannabis patients, 94% report that using cannabis has improved their conditions, and 73% report substituting cannabis for other medications. 4 in 10 consumers, both medical and recreational, report using cannabis to relieve pain. That is a broad category, and the question is what combinations of THC and CBD work best for specific conditions or ailments. Those companies who can develop tailored solutions backed by clinical studies will be the most attractive candidates when Big Pharma is able to invest in the sector. And lastly, branding. Competition is intensifying in the space, with larger consumer packaged players entering the market. Those operators who can build a strong brand with the ability to scale production and expand sales channels with little operational friction will be the most successful. Now, turning to challenges. One of the biggest challenges is clearly the lack of transparency and management depth in the sector generally. No matter what management team claims, there are 2 truisms in this business. 1, every business plan will take at least 12 months longer to implement. And 2, nearly every company we've invested in has not met their financial projections. 2019 projections turn out to be 2020 actuals. I joke that every management team uses the same pitch deck that shows revenue and EBITDA doubling or tripling every year based on assumptions regarding markets and products that have yet to be developed. The only difference is the pictures and the name. Based on our years of observing management teams, one of the most difficult challenges is the ability to scale operations, which is one of the primary reasons companies fail. Corporate governance, which I'm sure Hilary is going to talk about as well. This is one of the biggest challenges facing the industry in our view. And there have been several recent high-profile examples that have led to significant investor losses, including CanTrust, which announced or was discovered that they had unlicensed grow operations, Tilt, an MSO that had a massive goodwill write-down several months ago, and MedMen, where there are accusations of insider dealing and lawsuits. The next is knowledge gap. Cannabis is an opaque investment landscape, and timely and accurate information is a critical component of the investment process. It is also about asking the right questions, which only comes from a deep knowledge base and hands-on operating experience. Because of our extensive network, Merida is able to filter the most relevant information from the trivial and make the better or best informed investment decisions. Active investing. Simply writing a check does not guarantee investment success. That game is over. Cannabis investors have to be prepared for 2 things. 1, capital needs will always be higher than anticipated. And 2, investors have to be prepared to actively manage these investments, including board oversight, making management changes, and proactively generating new business opportunities. At Merida, we have a team of operating partners with expertise in marketing, supply chain, manufacturing, and distribution, and we make these resources available to our portfolio companies as needed. And then network effect. At Merida, we create value by the virtue of our portfolio ecosystem. Each new investment is viewed from the prism of how we can expand into new markets and how our portfolio companies can synergistically interact to create more value. And lastly, structured transactions. The primary way, or a primary way, to mitigate downside risk is to negotiate highly structured transactions using convertible securities, options, warrants, and strategic consulting shares. Almost impossible to do as an individual investor directly investing in a public stock. So in conclusion, the opportunity in the cannabis sector is tremendous, but there are so many ways to get burned as an investor. Merida has a 16-person team based on both coasts, and we believe that we have the depth and experience to deliver attractive returns to our investors. Hilary?
Fabulous. Okay. Can you guys hear me okay? Sounds like, okay, it's coming on. All right. Whenever I do any kind of engagement like this, I always want to know with whom I'm speaking. So if you're an attorney, can you raise your hand for me, just so I know? 1, 2, 3. Okay, not very many of you. How about in the CPA realm? How many CPAs do we have? Okay, and then my normal people who are just here to hang out. Yes. Okay, you guys are my favorites. All right. So normally in these types of presentations, it's going to range from a 101 knowledge base to the completely and totally advanced. I'm sure Larry's going to take questions at the conclusion of at least what I have to say. But no question, I think, is too amateur at this point because cannabis is still an emerging industry. And per our opening speaker's remarks, I've practiced in 3 different states, all really revolving around regulatory, M&A, and corporate governance, and each state is setting up the democratic experiment differently. There is no gold standard, and as an investor that may be exploring, let's say, the secondary market or some kind of investment into an operator anywhere across the chain of distribution, you're going to be dealing with a different regulatory landscape, which means different liabilities and different barriers to entry. Okay. So obviously the majority of my presentation is going to be on M&A and the risks and the pitfalls, but I would be remiss not to mention what the current status is with the federal government. I am sure the first panel educated you on where we currently stand, but I'll just reiterate, cannabis is still federally illegal. And even as an investor, you have secondary criminal liability, namely aiding, abetting, and conspiring to violate the Controlled Substances Act by virtue of your investment, potentially even in an ancillary company. This has not changed. And for all intents and purposes, with the current administration at the helm, this is not a hot button issue for them. And if Trump remains in the White House, it's pretty much just going to remain status quo. There's a lot of lip service in Congress to change or decriminalize, reschedule, legalize cannabis, but very little action to date. We've had a series of federal enforcement memoranda over the years that tell us how the federal government is going to do its job in a given state, in a given U.S. district, relative to those states that have cannabis reform. The most important thing you all need to know, including as CPAs, is that on January 4th, 2018, maybe 2 to 3 days after California kicked off adult use sales, then acting U.S. Attorney General Jeff Sessions issued a memo rescinding all previous federal guidance, and we're at ground zero. And the current status of the nation is that U.S. attorneys, which all have prosecutorial discretion, will enforce the Controlled Substances Act in their individual U.S. districts based on the resources and manpower and priorities within the district. Now, does anybody in this room know how many U.S. attorneys we have in California? We have 4. So that's 4 potentially different opinions from Sacramento down to the San Diego border. When you're looking at buying into or investing into a cannabis business, get to know your U.S. attorney, get to know what their enforcement priorities are. For all intents and purposes, they've all still followed the Cole memo from 2013, which came on the heels of legalization in Colorado and Washington. What that means, and we're going to get into due diligence, is that you only want to be looking at people, you only want to be advising your clients to be dealing with people who have licenses from the state, right? And in California, that also means local authorization, because the Cole memo, practically speaking, still reigns supreme, even if it's off the books as an enforcement guideline, okay? And just so you know, the U.S. attorneys here in California, they've been totally silent about Malcursa. They haven't really taken action one way or the other. And we're, more than a year into the experiment, so it's looking pretty good. And what that means is that M&A has continued to grow because we haven't had federal enforcement that would otherwise chill investment or the growth of the industry that we've seen in previous years. So these are going to be your typical investment opportunities still today, even with California leading the way, with 30 plus states with legal reform. The most attractive investments are obviously in the ancillary sector because you're not directly violating the Controlled Substances Act. But really what's most relevant is the last one, which is direct investment into licensees, whether that's through M&A or some other instrument. That is really what we're here to talk about because it is the most difficult because of the federal situation. All right, so I'm going to have a couple of slides. It's really 5 main things to know when you're looking at M&A in California. And you all, as practitioners on the tax impact side and legally, you're going to see more M&A. Because what's going to happen is massive consolidation in the marketplace because the little guys, the mom and pops, over time, they will not be able to compete with what's coming down the pipeline from the state on constant changes to rules, messing around with the taxation, and the constant cost of compliance on the state and local level. Okay, so you're going to see M&A more and more. We're going to have a really robust secondary market here in California. Frankly, it's already started. But the first thing to acknowledge is barriers to entry. And this goes back to the point that every state is doing it differently. Here in California, we don't have too many barriers to entry, which is a good thing for business. For example, we don't have a residency requirement for investors or for owners, right? And here the terms are owner and financial interest holder. We don't have a requirement that your capital coming in be seasoned in the state of California before it can be deployed to a licensee. So we really are very, very friendly. But there are 2 important barriers. Number 1, local authorization. We have a whole protocol for changes of ownership on the state level, but every locality does it differently depending on the entitlement in question. So if it's a permitting situation, for example, permits typically run with the land. The city probably doesn't really care about changes of ownership other than people who will be responsible for the day-to-day activity of the entity, as opposed to, for example, where I'm at in LA and the surrounding cities like Santa Monica, West Hollywood, Long Beach. They do care about changes of ownership relative to the local licenses in that jurisdiction. So you can't just do a clean buyout in California on the state and local levels. Those are our 2 main barriers to entry. And we have other things that are similar to other states. Don't be a convicted felon within a short amount of time, convicted drug trafficker. Don't engage in labor and employment violations. That's going to hold you up in the licensing process. But really the main point is for owners and financial interest holders, the 2 main barriers, they're at the local and state level on changes to financial interest holders and owners when they come into the business.
Do you mind?
Sure.
Is that all right? Because just apropos of exactly what you're saying. Can you hear me? In Los Angeles, the regulatory agency recently put, as you know, a moratorium on a change of location. Could you, that fits, and it really has changed the investment approach for people who wanted to buy in one area and move to another. Is that something that you're seeing anything or predicting? Thank you.
This is super, super salient to this conversation because most of these operators and a lot of people on David's slides that are looking at buying cannabis companies, they don't want the crappy real estate that these folks started with 10 years ago under the old laws that are now dead, repealed, or just rendered irrelevant. They want to move to a good location, primetime real estate, good parking, good traffic, low to no environmental impact. And cities like LA, and they're not the only place that have done this, they will, after enough input from stakeholders, and it's a political process, put the kibosh on being able to relocate. And in that instant, maybe what was your number 1 target is now probably off the table because of the inability to move. So basically tangential to this is a barrier to entry. The locals can shuffle the deck at any given point, and we will begin to see this. Another example, in Santa Barbara County, right, affluent community, at first blush, when Mount Cursa first passed, they opened their doors to the cultivation economy. They're now contemplating cultivation caps, which is going to stymie investment. It's going to stymie the money that's coming into that community, and it's a heavily politicized process. So it's not said and done even when you become an owner in one of these things, because the locals and the state can continue to shuffle the deck on really your prime time assets and your ability to do business successfully. Secondarily, closing can be a huge problem. And we are backwards in the state of California because what our state forces would-be buyers to do is actually to close on at least 20% of the outstanding equity of the company. That's the target. The reason is because the way the rule is written relative to changes of ownership is that if you want to own a cannabis company in California, you have to have at least 20% in equity or be in a management direction or control position. And the state, through many, many discussions over interpretation, has finally basically decided that they want the equity piece for incoming people. So you can't just appoint somebody as a director and call it good. They actually have to close on at least 20%, which has all kinds of ramifications. In addition, when you do that, you only have a certain amount of time where you have to tell the state that you've now come into the business, and then, and only then, they will begin the vetting process. In other jurisdictions, it is completely opposite. They will pre-vet the transaction, they will pre-vet the owner, nobody has to close on anything, but in California, we are very, very different. And this particular rule, the 80-20 rule, meaning basically you close on 20% and then call down the remaining 80 and finally close out the transaction, is particularly felt with distributors, labs, retailers, and delivery services because the Bureau of Cannabis Control is very aggressive about changes of ownership. And with a lot of companies that are coming into California, they are not even aware that this rule exists. And if you go for a full 100% buyout and then you tell the state, they will cancel your license, right? And we heard from CDFA about the temp and provisional issues that have now gone on. Same thing, you're starting from scratch. Not to mention, you may have also violated local law. Okay, diligence. Everybody knows due diligence is a pain anyway. In the cannabis industry, it's particularly ugly because you have a lot of legacy operators that were once operating as some form of a nonprofit. They probably were not compliant with the corporations code. They probably were not reporting all of their taxes. So these are extra hairy businesses on the diligence front. And I won't belabor the point. I think it speaks for itself. When you're doing a deal in cannabis, you need to go long and deep into the history of the company. And 9 times out of 10, it's going to be very, very risk-laden, which obviously affects what you're going to do in your M&A relative to holdbacks, reps and warranties, and indemnifications. And that's probably the toughest part in negotiating is that a lot of those legacy operators don't want to bear the risk of the liabilities that they've created. They probably don't even know what's coming down the pipeline from the IRS, for example. And it could be in the millions of dollars that you buy as the successor in interest. Valuations, probably goes without saying, valuations are still all over the place. It's more of an art than a science. A lot of these people do not have operational records that support the numbers that they're asking for. A lot of it is based on momentum. For example, in the city of West Hollywood, they had a very competitive licensing application process. None of those people have done a day of business. They probably will not open for another year. But because there are only 8 to 12 retailers with consumption lounges and delivery, those licenses just inherently provide value in the millions and millions of dollars because it is West Hollywood, is strategically placed for an influx of tourism, and there are no other licenses within that jurisdiction to service that population and those tourists. So again, a lot of the valuations are based on momentum. They really are not based in reality. Finally, this is my last point. You probably already broke the law. Don't freak out, but you probably have done something already that's going to lose you your license or put you behind the 8 ball because in California, licenses are not transferable. This is not a New York taxi cab medallion. They follow the company that holds them. So we cannot do asset sales of licenses in California. You have to buy the business that holds the license. This is almost always true if you want the local entitlement to carry over, right? And that's the development agreement, the CUP, whatever other land use entitlement that's following the company. You typically cannot transfer those things. And I see a lot of stupid work coming out of asset sales with totally illegal sales of just licenses. Second point. You can't pull licenses out of your vertically integrated company and sell them off. That's not happening. And it's not happening on a local level either. Again, I've seen a lot of missteps where that's already happened and money's already been spent. That's not an enforceable agreement, folks. Also, timing. Like I mentioned, if you come in as an owner, you must first initially close on at least 20%, and you have to report the transaction to the state, depending on the agency, within 10 to 14 days of the effective date of the change. You don't do that, that's a major rule violation warranting license cancellation, because we now have an undisclosed owner on the books, okay? And that is very specific to California. Also with the locals, just recognize all 482 cities and 58 counties are doing something differently. If you're going to buy into or invest in a cannabis business, you really need to check what the disclosure requirements are. And for funds, for private equity money, for investors far aflung, they're not going to come here and do DOJ background checks, right? They don't want to be disclosed. There's political ramifications for that. They don't want to be a drug trafficker. So keep in mind, in addition to state disclosure requirements, the locals could be much more invasive, and in fact, some of them are. Lastly, and not to knock a Canadian pubco, God bless them, they're everywhere. They are throwing money around in the space very recklessly on the regular. Most of them are extremely disorganized. They're really just looking to get to the next press release. They won't do any of this diligence or any of this work to confirm that they've done a lawful purchase and that they're in compliance with the rules. And basically, once the state gets into enforcement mode, which is probably maybe a year from now, we're going to see a lot of canceled licenses on the back of some very bad M&A. I'll skip this one briefly because we're going to talk about it anyway. This slide is dedicated to entity structure and M&A and what we're seeing. There's a lot of nonprofit to for-profit conversion that's being done improperly because the corporate governance documents don't actually allow it, or they violated the corporations code. The other entities in the marketplace are going to be LLCs and corporations, typically a C Corp, to avoid 280E personal liability more effectively. And we're starting to see more acquisition entities for tiered mergers. And by tiered merger, I mean following the 80-20 rule, and also because these cannabis businesses have a ton of ancillary businesses that surround them, like payroll, IP holding companies, management companies, etc. And these are the trends that I think are shaping the industry. Most operators don't want to compete. They're looking for an exit. There's going to be a massive consolidation period probably over the next couple of years. Competitive licensing is increasing for retail specifically in these more affluent, exclusive communities, mostly down in Southern California. Social equity, I'm sure you guys are familiar with that in San Francisco, Los Angeles, a couple of other cities. This will have a massive impact on M&A in those locations because 9 times out of 10, those companies actually cannot be sold at all. And if they are sold, you have to maintain the social equity status throughout the deal, which is extremely difficult to do when taking potentially Wall Street money. Also, more brick and mortar retailers are turning to tech delivery platforms to basically streamline their operations. Very interesting impact on M&A to be able to acquire the tech platform, which has nothing to do with licensing, might make life easier. And lastly, again, the publicly traded companies from Canada are really, really rushing to buy up these overvalued assets, particularly in the retail sector. And a lot of those folks are going to go bankrupt and lose their licenses because they have not followed the rules. All right, that's it. Thank you so much.
Thank you, Hilary. That's amazing. I have a comment, and then I have a couple questions for both of you. First of all, with regard directly to what Hilary said about the non-transferability of the license themselves, and therefore you have to approach it with and through the equity of the licensee. Remember that if the form of the investment you're taking or your client's investment is in debt, and that debt is secured, and a significant amount of the value is located in the license, which is all too common because, as you probably know, with clients in this industry, or if you're in this industry, you might have people who have the license but maybe not necessarily the large business vision. So you're taking over and attempting to superimpose maybe best practices and economies of scale. Remember, if you want to secure the loan with the value of the license, you have to do it through a pledge of the equity of the licensee. And that is very important to do, and it's not always easy, and it involves, I don't want to get into secure transactions about how you perfect liens, and it's different. It's not just a UCC1 filing. It's, all those things we could talk about, and we could really bore you to death. But that's very important. My first set of questions are for David. And again, as a hedge fund manager and someone that was always out there raising money from investors, If it's a private equity type investment, the second thing, other than the fees, the investors always ask about what's your exit on the particular investment. You have a portfolio. What's the exit going to be? How long will the fund be? How do you monetize it? When I first looked at cannabis from the investment side, the buzzwords, no pun intended, although it's not bad, were about reverse mergers into Canada, creating the entity, selling them off there, or an IPO in Canada. I think what Hilary said about the valuations and what we've talked about valuations, I think reality's starting to set in a little bit there with these, 30 to 40 times revenue multiples for companies that aren't doing, any positive operating cash. What are you telling your investors about the time horizon and the potential exits that will allow you to, obviously pay out on the fund? That's question one. And then two is, with regard to financial interest holders, once you're an investor in a cannabis company in California, you're categorized as an entity that has to be reported. And the BCC has taken the position, and I think that it's clear that requirement goes all the way down to the individual investor. At times the actual person. What are your investors dealing with that? Are you telling them about that? Are they asking about that?
All right, there's a lot there. So in terms of exit strategies, so Merida is structured as a traditional private equity fund, so it's a 5-year investment period. And, our assumption is that a lot of these, we're building companies from scratch, and it's going to take time to develop their businesses, several years. I think the big game certainly a year ago was the RTO path in Canada. That is over. You've had over the last 12 months, let's say 12 to 15 major MSOs in the U.S. that have taken that path. And if you look at the trading dynamics now, most deals that have been done in the last 6 to 9 months on the U.S. side, those equities are down anywhere from 15 to 75, 80%, depending on the dynamics at each individual company. So that easy money, that process of doing the RTO route is, I think for the most part, that door is closed. At the end of the day, our objective and what we hope to do is to build very high quality companies in all the different verticals that we're focused on. And as regulations change, as the industry becomes more institutionalized, I think the opportunity is going to be purchased by more institutional, traditional players, in addition to large MSOs, both in the U.S. and Canada, that do, as Hilary mentioned, the amount of capital being thrown around by Canadian companies, particularly in California, is significant. So at the end of the day, if you build a quality company that's a leader in its vertical, there will be an exit strategy, whether it's an MSO, whether it's a go public route, or whether it's a traditional industry player. And then in terms of I'm not sure in terms of the second part of your question, what you exactly were looking for.
So I just want to clarify, and if you disagree, Hilary, obviously feel free to chime in. My understanding of the requirements regarding financial interest holders is that within 14 days of an entity becoming a financial interest holder, that entity has to be reported to the BCC. The BCC has taken the position, and I think is reserving the right to take the position, that if the financial interest holder is an LLC, they reserve the right to see every member of that LLC. And if the members of the LLC, if a member of the LLC is in and of itself an LLC, then the BCC reserves the right to see the individual investors in that member LLC. So my question is, have your investors, are they on to that? Because that's something that we're starting to advise clients to be very careful about, because many of our clients say, well, we want to invest, but we'll do it as an LLC so our name won't come up. And we say, nah, that's not going to work. That's where I'm going.
I'll add on to that. So in California, we have two important parties, owners and financial interest holders. Financial interest holders are anyone or any entity that owns 19% or less of the equity in the cannabis operator, anyone who makes an investment or a loan or has an equity interest. The last one is basically profit sharing. Can take any form, whether it's an IP royalty, a percentage of profit as rent. all of it qualifies and it signifies disclosure. And if it's an entity in the rules, they are supposed to give over their tax ID and their name. And if it's a human, they give over their first name, last name, government issued ID, and birth date. The BCC clarified, though, in January in its final rules that if you have a multi-tiered corporate structure leading back to your financial interest holders, they will blow through that structure until they get to the humans to get that nominal amount of information, and they have only gotten stricter about it. And P.S., we only have a few exceptions to this rule. Basically, if you are a blind trust or similar instrument, no disclosure. If it's a security interest only, no disclosure. And if you're a publicly traded company and you hold 5% or less of the outstanding stocks, no disclosure. But that's it. And I skipped one, financial institution. If you're a bank and you make a loan, no disclosure, but don't get cute and say you're a financial institution under SEC regs, they're not going to buy that. Right? If you're a fund or whatever, you're getting disclosed. And this is when we hit issues on financing and in M&A where these individually wealthy people or high-profile people go, whoa, pump the brakes. I am not giving over my personal information. And we have problems. And then we get these very convoluted structures where they only want to invest in the ancillary side that provides goods and services to the licensee, but they have no control. They have no control over the purse strings. They have no leverage. And it basically eliminates the entire point, but they still get to tell their investors that they're participating in the industry. So that's the main issue in California. And frankly, everywhere it's ubiquitous is disclosure. The states are not playing around, and it stems from the DOJ enforcement memos. They want to know who is playing in a federally illegal space.
That's exactly the point that I was driving at. We had an investor come in who was a high-profile, high net worth individual, very interested in the cannabis space, but of course wanted to keep his name out of it. And it took us 10 meetings to explain to him, we can't guarantee that, and in fact, it's not going to be the case. A follow-up question for Hilary, and then a question for all, and then if there are questions out there, please just indicate, and I'll shut up or I'll try. You mentioned on the 80-20 rule that it's settled law. I think I understood you saying that it's settled law now that the 20% sort of legacy the legacy owner that has to be in place in order, for example, to allow the company to stay active.
I didn't even explain that part, so you can feel free to explain.
Okay, so this is one of the issues that's coming up in secured transactions. If my client is a lender and has taken, as I said, a security interest in the equity of the licensee. Can't take the license. Again, we're going to keep hammering that home. It's got to be in the equity of the licensee. And the loan defaults, which is bound to happen, not in every case, but it's going to hit this industry for sure. And the lender wants to foreclose, because that's what lenders do in order to enforce the loan. If the lender takes the equity that it's holding, in which it's holding a security interest, via the pledge, that lender has to be careful now, because if it takes 100% or frankly over 80% of the equity in one fell swoop, then while the lender is applying for its new license, which it's going to have to do, in that interim, the business has to stop operations. You have a business interruption that could be fatal, especially to a young business. So the way to do this, the way to do this is, the way to avoid that pitfall is to leave an existing owner in place, because the regulations make clear that if there is at least one owner that stays in place during a change of ownership of the licensee, you can stay open. The entity can stay open and continue operating while the foreclosure process. There does seem to be some question as to whether that, I'm going to call that a legacy owner, the one that stays there, whether that legacy owner has to be a 20% holder, or can it be one of the other categories of owner vis-a-vis the control? And I'm wondering, I know I've spoken to different analysts at the BCC, and you don't always get the same answer.
I know, or you get a non-answer. But mostly, like Larry is saying, you're going to get 10 different answers. And this is what I'll tell you. Most conservatively, to satisfy this rule, you would leave the legacy operator at least 20% in equity. They cannot question that on its face. It's indicative that you've satisfied the rule. If you leave that legacy operator on as a manager, a director, an officer, you are playing with fire with the BCC. And I can tell you this from firsthand experience. We had a Canadian publicly traded company that came to us after the fact. They did a complete and total buyout of a dispensary. They told the BCC that they had done this. They left the original owner on as a director in the new entity, and the BCC said, that's not good enough. We're going to move to cancel your license. What's your current mailing address? And it took our firm, team of lobbyists, to try to get them to reverse, and we still do not have a resulting decision. And we went back and forth with them and back and forth with them over what the term ownership interest means, because it's not defined in the rules and it's not defined in the statute. And an owner is anybody with 20% or more in equity, or basically anybody that's in a management, director, or control position. And they came back and said over, the most benign email, well, when we said ownership interest, we really meant equity. It's not defined that way. So that's a good lesson that right now in this atmosphere where the rules are still kind of emerging on these really fundamental issues, that is not an area where you ask for forgiveness later, because they will use the baseball bat and not the carrot, right? Because they're very touchy about who's in control. They know a lot of bad behaviors going on in California. We're very large. It's very tough to get a handle on. So in that area, while I would love to be creative and say, yes, leave them on as a director, you're totally fine, you've satisfied the rule, I do think the regulators will bite back. At the same time, on a case-by-case basis, you may be able to ensure that you've preserved continuity in operations so much that the change of ownership on the equity side is meaningless. Allegedly, that's what they were looking for, but not necessarily in practice. So I would advise to be conservative.
Well, I was just going to add, it sounds like there's a lot of complex issues in California that are unique to the state.
Yeah, we're terrible.
Which is one of the reasons why at Merida we have a diversified portfolio, and we set up the structure so that individuals are shielded in our investments. We have a lot of ancillary investments, so we don't have a lot of licensing issues. Yeah. And we're also playing in states in the Northeast, either on the dispensary or cultivation side, that are easier to purchase and don't have the same regulatory requirements or issues that you're dealing with in California. So from an investor perspective, I think that's what you want. It's important to have a diversified portfolio and to go to the states that are easiest to do business in and creating value. So, we have some California assets and some very interesting opportunities in California, but we also have assets and companies that we've invested in, throughout the country in many different jurisdictions.
It's a huge point, and in the last 5 minutes we're going to take questions, but if you're going into investment, don't just go to someone who says, hey, weed's cool, let's make money. You got to go to somebody, a firm like David's, that has experience, that understands the pitfalls and the traps. So I appreciate that. So, sir there's a question over here.
I wanted to bring this down a little bit to what's important to people in this room. So following up on Hilary, actually everybody, there's a tremendous amount of work opportunity for us in this room. If you're not representing clients in the cannabis space from an income tax standpoint, a lot of these Canadian companies are coming in, they don't understand U.S. tax law, they have no idea about U.S. GAAP, and they're looking to us to help them do their financial due diligence. That's a tremendous opportunity for people in this room to help out. We were hired by a Canadian company to do some financial due diligence on a dispensary in the desert, in Palm Desert. And, we asked for the usual things: tax returns, sales tax returns, business license returns, blah, blah, blah. They gave us the corporate income tax returns, but it was very obvious that they weren't following the rules under 280E. And when we asked for balance sheets and income statements, the accountant who was handling the account looked at us like we were like speaking Greek, okay? And I tried to explain to this Canadian company that how can you go through with a purchase when you don't even have a balance sheet and an income statement, right? How do you know they're making any money or not? So they were more concerned that their POS system was reporting the sales correctly and that they filed their sales tax returns. They wanted us to help them compute what their potential liability would be if they went ahead and took over this business. So we did provide them that information. What also concerned me was that the accounting firm that was originally representing this client was a large regional firm that I respected and I knew was heavily involved in cannabis, and I knew that they knew what they were doing. The following year, they were not the preparers of return, with some accountant in the desert that I'd never heard of. I did a little research and went on Yelp, and let's just say that if you went to that person's office and you went 2 storefronts down, you could go buy yourself a Slurpee. I mean, I'm not saying that she wasn't competent, but she could not provide us with an income statement or a balance sheet. She had no idea what I was talking about. By the way, they went ahead with the purchase.
Of course they did.
Hi, I'm John Paul, CFO in the industry, and I'll be speaking at the lunch panel about the other direct challenge of going U.S. to Canada and going public. One of my questions is, yeah, there's opportunity for a lot of M&A, but you got these crazy valuations out there. I'm mystified by the valuations on the MSO deal that we've seen, and meanwhile you try to look at a private company and their heads are all messed up. They think they're worth that kind of money. So how do you deal with that and kind of get them grounded in reality?
Well, first of all, the market multiples have come down quite a bit, and there was always a spread between Canada and the U.S. Canada was always trading at a premium given the development of that market versus the U.S. names. And as I mentioned before, that there's now a glut of MSOs in the U.S., and so there have been, prices have been going down quite a bit. Valuations have been going down quite a bit. Management teams have pretty lofty expectations of what they're worth, but at the end of the day, the market, tells them what they're worth. How much money can you actually raise at what valuation? And we tend to, at Merida, we do highly structured transactions where there's a lot of options and warrants and upside that's built into it. And we always try to purchase things at a pretty significant discount to the public multiples. But, at the end of the day, it's a process. And I would say that most companies are unrealistic about what they're worth. And getting that capital is really, at the end of the day, it's not just about the capital that these companies want. They want the ability to work with a firm that can introduce them to new markets and new business opportunities and help them grow their business. Because I think one of the things that's pretty obvious is that people don't know what they're doing for the most part. They don't know how to grow their businesses. So the value add is, we can maybe buy something at a discount, but we're going to provide you an entree into certain markets. We're going to find acquisitions. We're going to synergistically combine our portfolio companies to give you a business platform that you would not otherwise have. So that's the bottom line. So if you can add value in that way, then you can purchase things at a much lower price because people want that. And that's a rare commodity.
We're at 11:35. Thank you, David, Hilary, and Larry. An outstanding presentation and lots to think about from the investment perspective. Thank you all very much. Mr. Mayor.